real estate investments. We have categorized our investments into 5 main categories, judging them based on the perceived risk of the investment. Within these categories, however, there could be a combination of real estate investments with different tactics, different markets, expected returns, timelines, and much more. To simplify the process, we narrowed it down to 5 factors, and if you're interested to know why exactly the risk is low or high, you can proceed to read our studies and analysis on this specific investment in more detail. Within these investments, we have chosen, based on our studies, how long one should hold the investment for, indicated by the term. Our main goal from each transaction is to be able to execute the best deal and biggest return possible from that specific strategy and investment. Let's take a look at the first category, Category A, labeled Pretty Sure. In this category, you can expect the safest returns. Nothing is ever guaranteed, but here we choose investments that are not expected to fluctuate too much and have been known to offer a stable return in the good times and the bad. The timeline for these is usually moderate to long, 3 to 5 years or more. This could be a floor in an office building generating a 5% yield and has been doing so for a while. Other factors could be that the tenant is trustworthy, like a big bank or law firm, and the building is in a fully developed and predictable community. Category B comes next, labeled Safe, because it usually will be. These will usually be a very similar investment to those in Category A, with a slight factor that adds a level of uncertainty. Consider the same exact floor, but with a tenant leasing annually, and could decide to leave any year. The building is still in a safe and predictable location, but the income is not as streamlined. Another factor could be that this building is in a community that is up and coming and doesn't have the long history that a Category A investment would have. Moving on to the moderate risk, Category C. These investments will have moderate returns and usually a moderate timeline too. Here there will usually be an uncertainty factor, whether it is the market speculation for the specific region or the actual asset itself. An investment in this category could be a property that is in a great community, but is quite old and undesirable for the moment. By adding value to the property through small changes, we can make it more attractive and eventually find a tenant to lease it and sell it for a good margin on the exit. Another example would be to invest in a property that is expected to drastically increase in value later on in the duration of the investment. For instance, buying several homes that are leased, but we think will be extremely valuable due to the new park and attractions that are being built next door. This is how this category involves some speculation, but could still be important when diversifying your portfolio. The next 2 categories involve more risk, but with an increase in potential return. The first category, D, slightly risky, and the next is Category E, very risky. These categories will follow the same pattern, but if the team at Durise thinks there is a variable that is definitely labeled to have the most risk, then we would label it as such. The riskiest projects will be those that are even more unpredictable, such as property in a city that has yet to take shape and place. Not only will the real estate take time to construct, but it will be a while before the value increases to become investment grade. Usually, a city requires a bare minimum of 5 years before attracting new tourists or population to relocate to it. To a lesser degree, property that would require significant upgrade, remodeling, or rebuilding would fall under Category D and sometimes E. These are properties that we have access to at very attractive prices, but are uninteresting for the time being. Adding value to these properties could spike interest, but to the right buyer, and that on its own requires time. This tactic could prove highly profitable, but the timeline is difficult to guess and could greatly impact the optimal returns. In the end, the decision is yours. The ideal model will consist of a diversified portfolio to include some moderate to high-risk investments and other safer ones that will offer a passive income. Focusing on either extreme too much will either be too risky or too slow in terms of capital gains. Whatever you decide, we are here to help and offer our advice.